Only people who get it are the people who get it. Welcome back to Jay Get It. Today we're breaking down one of the simplest, most underrated savings strategies, the CD ladder. If you've ever asked, what is a CD ladder? How do I start one? Or, why do people use CD ladders? You're in the right place. A CD ladder is basically a way to earn steady interest while still getting regular access to your money, without trying to predict the perfect moment to lock into one CD. We'll keep it practical. What it is, why it works, how to set it up based on your budget, and what mistakes to avoid. Before we build a ladder, let's make sure we understand the building block, the CD, or certificate of deposit. A CD is a bank product where you agree to leave your money deposited for a set time, like 3 months, 6 months, 1 year, or longer. In exchange, the bank pays you interest, often at a fixed rate. The trade-off is liquidity. If you cash out early, you usually pay an early withdrawal penalty, often measured in months of interest. So CDs are best for money you can park and not touch daily. Think of CDs like interest-paying time locks. A ladder helps you manage those time locks intelligently. So what is a CD ladder? A CD ladder is when you split your money into multiple CDs with different maturity dates. Each CD is a rung on the ladder. Instead of putting all your money into one 12-month CD, you might do 3-month, 6-month, 9-month, and 12-month CDs. That way, you don't have all your money locked up at once, because something is always maturing on a schedule. And when a CD matures, you choose, take the cash or roll it into a new CD to keep the ladder going. People use CD ladders for 3 big reasons: predictability, access, and rate timing. First, predictability. You know what you're earning and when your money is coming due. Second, access. A ladder creates mini maturity dates, so you can reach money regularly without breaking a CD early. Third, rate timing. Nobody knows what rates will do next. A ladder helps you avoid the regret of locking all your money into one CD right before rates rise, or keeping everything short right before rates fall. A ladder makes your strategy more stable, even when rates move around. Let's break down the advantages. Advantage number 1. Regular liquidity. Every time a rung matures, you have a decision point. That's powerful. Advantage number 2. Less reinvestment risk. Reinvestment risk is the risk that when your CD matures, rates are lower and you can't replace that yield. With a ladder, only part of your money faces that risk at any one time. Advantage number 3. You can capture higher rates over time. If rates rise, your maturing rungs can roll into higher yields. Advantage number 4. Goal planning. Ladders are perfect for planned goals, tuition, a down payment, a business cash buffer, or a future expenses fund. Now for the part most people skip, the downsides. Downside number 1. Early withdrawal penalties. If you break a CD early, you can lose months of interest, and it can hurt your return. That's why ladders are built to reduce the need to break CDs. Downside number 2. Inflation risk. If inflation runs hotter than your CD yield, your real buying power may not grow much. Downside number 3. Callable CDs. Some CDs let the bank call the CD early, which can interrupt your ladder when rates fall. Downside number 4. Brokered CDs. These can be fine, but if you need to sell before maturity, you may have to sell on a secondary market and could take a loss. So the rule is, keep it simple, read the terms, and don't ladder money you truly might need tomorrow. Not all ladders are the same. Pick a ladder style based on your goal timeline. A short ladder, 3 to 12 months, is great if you want flexibility and frequent access. A medium ladder, 6 to 24 months, balances access with better yields. A long ladder, 1 to 5 years, is for people who want to lock in higher yields and don't need the cash soon. There is no best ladder. The best ladder is the one that matches your real life, your bills, your emergency needs, and your savings goals. Here's how to build a CD ladder in a clean way. Step 1. Choose the total amount you're comfortable locking up. Step 2. Choose the number of rungs, usually 3 to 6 is simple. Step 3. Choose the spacing. Example: every 3 months, every 6 months, or yearly. Step 4. Buy the CDs and track the maturity dates in a note, spreadsheet, or calendar reminder. Step 5. When a CD matures, decide: do you need the cash, or do you roll it into the longest rung to keep the ladder going? That's the ladder engine. It keeps your money rotating and earning. Let's do a simple $5,000 example. You take $5,000 and split it into 4 equal rungs, $1,250 each. Then you buy a 3-month CD, a 6-month CD, a 9-month CD, and a 12-month CD. Now you've built a schedule. Every 3 months, something matures. When the 3-month CD matures, if you don't need the money, you roll it into a 12-month CD. Then when the next rung matures, you do the same. Over time, you end up with a ladder where you always have a 12-month CD maturing every few months, steady access, steady yield. Now a $20,000 example for someone who wants a medium ladder. Split $20,000 into 5 rungs, $4,000 each. Then choose terms like 6, 12, 18, 24, and 30 months. This gives you a maturity event every 6 months, great for planning. As each CD matures, you can either take the cash for goals, or reinvest into the longest rung to keep your ladder fully built. This style is popular for people saving for planned costs, like tuition payments, a business cash reserve, or a home project timeline. For larger amounts like $100,000, the strategy is buckets. First, keep your emergency funds separate in something liquid, like a high-yield savings account, because emergencies don't care about CD maturity dates. Second, ladder the money that's truly goal money, like a down payment or a conservative savings allocation. Third, if you have very large balances, consider spreading across multiple banks to manage deposit insurance limits and diversify rates. And fourth, you can mix strategies, some in a CD ladder, some in savings, and for some people, short-term treasuries depending on your goals. The key is matching the ladder to your life, not forcing your life to match the ladder. Here are the best practices that keep CD ladders smooth. Don't ladder your emergency fund. Compare the APY and the early withdrawal penalty, because a high rate with a harsh penalty can still be a bad deal if you might need cash early. If you're a beginner, avoid callable CDs, because they can disrupt the ladder when the bank calls them. Track your maturity dates and set alerts, calendar reminders, bank notifications, or a spreadsheet. Your ladder is only powerful if you actually manage it. Let's wrap it up. A CD ladder is multiple CDs with staggered maturity dates. People use it for higher yield than parking money in checking, predictable returns, and scheduled access to cash, without trying to guess the perfect rate moment. To build one, choose your total amount, pick your number of rungs, choose terms that match your timeline, and roll maturities forward if you don't need the money. Now the quiz. Drop your answers in the comments. Question number 1. What is a rung in a CD ladder? Question 2. Why would someone choose a ladder instead of one long CD? And if you want the next lesson, I'm adding more videos to this series, like how to compare CD rates, CD ladder mistakes, CD ladder versus treasury bill ladders, and how to ladder inside an IRA. Disclaimer. This content is for educational purposes only and is not financial, legal, or investment advice. Please consult a qualified professional before making any financial decisions.